Good day. Welcome to the Financial Sector Conduct Authority's presentation on a risk-based approach. My name is Charl Geel. I'm a senior specialist in the Office of the General Counsel within the FSCA, and I'm joined today by Michéle.
Good day, everybody. My name is Michéle Fourie, and I manage the FICA Supervision Unit in the Financial Sector Conduct Authority. I hope you enjoyed today's presentation. Today, we're going to deal with a risk-based approach to customer due diligence and supervision. And on the agenda, we'll specifically discuss the risk-based approach to customer due diligence, risk assessment, the sector risk assessment, and the risk-based approach to supervision. So to get the conversation started, I would like to ask Charl if he can help us understand the difference between the type of customer due diligence that accountable institutions were required to conduct before the amendments to the FICA Act came into effect. So when the rules-based approach was still applicable versus the risk-based approach that is currently a requirement. What is the difference, Charl, between the type of customer due diligence expected by accountable institutions to apply to their customers?
Thanks, Michéle. Yes, the rule-based approach that was applicable prior to the amendments to the FICA Act were contained in the regulations to the FICA Act. With other words, it prescribed exactly what you have to do when you conduct customer due diligence. For instance, if your customer is a natural person, it would state that you will have to obtain the full names, date of birth, ID number and residential address from the client, and you verify that information by obtaining an ID book and a document stating the client's residential address. So the rules were specifically stated within the regulations. Post the amendments to the FICA Act, it now makes provision for a risk-based approach to customer due diligence. What that means is there's no rules anymore, or very few rules in any case anymore, when it comes to customer due diligence. So there you will have to determine yourself what information you are going to obtain and how you're going to verify it in terms of your risk assessment of the client. Now, the contents of the risk management and compliance program in which you will have to specify that information is prescribed for in section 42 of the FICA Act. Sections 28 to 21.8 sets out what minimum information you have to obtain, while in your own risk management and compliance program, you will set out how to obtain information and what additional information to obtain.
So Charl, it sounds like there's this clear message that we moved from a rules-based approach to a risk-based approach. But does that mean that all rules are off the table now, or are there still maybe a few applicable in the environment, the regulatory environment that we find ourselves today following the amendments to the FICA Act?
Yes, there are certainly certain rules that's still applicable. And if I may explain it by referring to a sandbox. The sandbox has got 4 squares. The 4 squares represent rules of the sandbox or the size of the sandbox. In your risk-based approach, you also have the certain rules that you have to apply. If you look at the green block, the green side of my sandbox, it states that no anonymous clients or clients acting under false or fictitious names can be onboarded. In other words, that's a rule. You cannot write in your RMCP that you're not going to identify or verify a client. It certainly is still a rule that you need to identify clients, and you shouldn't transact with any clients acting under false or fictitious names. The second side of my sandbox, with other words, the second rule that I'm referring to, is understanding and obtaining information on business relationships. So the FICA Act has got specific requirements there, certain questions that you will have to answer, some information that you will have to obtain when dealing with a business relationship. The third side of my sandbox, the third rule, is additional due diligence measures relating to legal persons, trusts, and partnerships. So there are specific information that you will have to obtain and verify when dealing with these types of clients. My fourth side of my sandbox, or my fourth rule, is enhanced due diligence for foreign prominent public officials and domestic public it's a DPIF, so it's a domestic prominent influential person, and their families and known close associates. So certainly if you're dealing with these type of people, there are additional or enhanced due diligence that you will have to obtain. So apart from these four rules, you can play in your sandbox and you can determine what information you want to obtain and how you're going to verify it. And all that is based on your risk assessment of the client.
So clearly, we still have a bit of rules that we have to comply with. If we move to the next slide, we continue the discussion with regards to customer due diligence. And perhaps Charl can elaborate a bit on the systems and controls that an institution can decide to use to manage these risks.
Yes, as indicated, the flexibility is now within the accountable institution to obtain information and to verify that information depending on the risk rating of the relevant client. But whatever you decide to do as an accountable institution, you should always have grounds on which you can base your decision. What's your justification why you rate somebody as a low risk, a medium risk, or a high risk client? And an appropriate balance should be struck in any given circumstances. The systems and controls which you decide to implement should be based on the due diligence that you are going to conduct based on the risk assessment of the relevant client. That obviously needs to be documented in your RMCP. With other words, you can't just decide on your own, I'm just going to ask an ID, but it's not documented in your RMCP. It's very important to have that type of information. With other words, that the risk documented within your RMCP so that everybody understands what to do, and we as a regulator also understand what information you obtain and how you verify that information and how you do your risk assessment.
So Charl, it's very clear then that there is a definite distinction between the different risk ratings applied to customers and then the type of customer due diligence one would apply in line with that risk rating. So what can you tell us about the difference between, for example, the type of customer due diligence applicable to a high-risk client versus a low-risk client, for example?
All right, so if you rate and you do your risk assessment and you've rated a client as high risk, that means that you will have to conduct enhanced due diligence on that specific client. So what does enhanced due diligence mean? It means that you have to obtain more information on from the specific client. You have to confirm or verify that information with more secure data. And you also have to do a closer scrutiny of the client's transactions. That ongoing monitoring should be quite closer when you're dealing with a high-risk client. Contrary to that, if you're having a low-risk client, we're talking about simplified due diligence. So that is where less information is obtained from the client, and you also use a less secure confirmation of that information that you've obtained from the client. And obviously then there's a less frequent scrutiny of the client's transactions.
So Charl, this brings me, I think, to one of the most important questions that is perhaps also on the mind of the accountable institution watching this presentation today. And that is, how do you conduct a risk evaluation and make that distinction when you're not relying on a rules-based approach anymore?
Yes, Michéle, I think it's a lot of accountable institutions are struggling with a risk evaluation. So I'm going to try and explain the risk evaluation. A risk evaluation is an evaluation that you do as an accountable institution. There are a few factors that you have to consider. The factors that you have to consider relate to client types, the products and services that you offer, as well as the delivery channels. Factors that you consider are not numerous clauses. With other words, it's not only those three type of factors. You can actually have more factors that you include. But as a basic, I would suggest that at least these three factors are being considered by you as an accountable institution when you do your specific risk evaluation. So going on, so I'm going to explain these risk factors to you. With other words, you first look at your products and services. This is just by way of an example. For instance, you sell a funeral cover and also unit trust. So those are the products that you sell. Who do you sell it to? With other words, the geography of your clients. You can sell it to South African citizens, or you can sell it to international citizens. That is all depending on your own model of your business. And then obviously you're the client type. Client type is whether the client is a natural client, whether it's a legal person. You can also have more information like is the client a PEP or a DPIP and so forth in your considerations of clients. So this is merely an example. What you then do is if you're dealing then with a product type, for instance, funeral cover, you say my funeral cover that I'm selling is low risk. And the reasons why I'm saying it's low risk is because the product cannot be converted into cash quite easily. It's a relatively low value product, and the product does not provide anonymity of the client because you do obtain the client's information. And that's why you rate the product as low risk. You will go through the same process when you're dealing then with the geographical location issue as well as the client type. In other words, you will rate each of those factors, saying whether they are low, medium, or high risk. It's very important to state the reason why you state that a specific factor, with other words, the client type, geographical location, or product or services are medium, high, or low. Because we as the regulators need to understand your reasoning behind your rating. I sometimes get the questions, but where do I find what is high risk or low risk? Guidance Note 7 issued by the Financial Intelligence Center is a very useful tool in obtaining information about high, low, and medium products, client types, as well as geographical location. But that's not the only source. You can also look at the sector risk assessment, which I will deal a little bit with later on. But in the sector risk assessment, it will also give you indication what of these factors are medium, high, or low risk. And then we've got a national risk assessment that has been done. And that national risk assessment will also give you an indication what is medium, high, or low. And please use those factors in the sector risk assessment, the national risk assessment, as well as Guidance Note 7. Obviously, we will also issue further guidance on this issue, so please be on the lookout for further guidance on risk factors in the future. Ideally, you should give more than one reason why you rate a certain factor as a low, medium, or high. Not all products, geography, and client types can be low or medium risk. In any organization, there will be a low, medium, and high risk factors. So, and we've seen it quite often where a person would say, well, I only have low risk clients. But that means that that person or that accountable institution haven't considered all three factors or more than those three factors when indicating the risk rating of the relevant client. And please steer away from a general statement. The client is low risk because there is low risk for money laundering in the specific sector, or because that's simply not entirely correct. Please consider all the factors, and at least the three factors that I've indicated in the slideshow. What I'm explaining to you now is one way of doing a risk assessment or a risk matrix. It's definitely not the only way that you can do a risk assessment or a risk matrix. So for instance, if you have a funeral cover as a product and you rate the product as low risk, you can allocate a value to that product as saying it's a 1. If the product is a medium risk, you can add a value to say it's a 2, or if it's high risk, you can add a value saying that product is valued at a 3. The same you do then with your other factors as well, your client type and geographical information. What you then do is you add up your 3 factors. In other words, if your product is then a low risk and you've allocated a score of 1, but the geography is a medium risk, in other words, it's a score of 2, and your client is also a medium risk and a score of 2 is allocated to that client, then you've got a total score of 5. In terms of your risk model, your risk matrix, if the total is a 5, you say, this is a low risk client, and therefore you will implement a simplified customer due diligence. Your matrix can, for instance, say if the total is a 6 to 7, then it's a medium risk with other words standard customer due diligence, and if the total score is 8 to a 9, you would say this is a high risk client, and therefore enhanced due diligence is required. And then your matrix must state what you're going to do with regards to a low risk, medium risk, and high risk client. So for instance, your low risk client, you can say, I will obtain the full names, ID number, and source of funds from that client, and I'm going to verify that information by obtaining an ID or passport or driver's license. For instance, you can also do with a medium risk client where standard customer due diligence is applied, where you obtain the full names, ID number, source of funds, and residential address, which is an additional requirement for a medium risk client. In that case, you will obtain an ID or passport and proof of residence. And then you can do the same for enhanced customer due diligence. So again, full names, ID number, source of funds, source of income, residential address, work name, and address. So those are additional information that you're going to obtain from a high-risk client. And how are you going to verify that information? You're going to state in your risk management and compliance program, I will obtain an ID or passport, proof of residence, 3 months salary advice, and 3 months bank statements. So this is just an example of how a typical risk matrix will look like. I think very important, again, you have to consider all 3 factors when you allocate a rating to the client, whether it's low, medium, or high risk. And then you also have to state what information you're going to obtain and how you're going to verify that information. As I said in the beginning, for a low risk client, simplified due diligence. By high risk client, enhanced due diligence. With other words, more information, more secure verification, and obviously more secure and frequent monitoring of transactions of a high-risk client.
Well, Charl, that certainly helps me understand how to conduct a risk evaluation if I was in the shoes of an accountable institution that struggled with the question, how do I start or where do I start? But bringing the conversation closer to home, the accountable institutions may wonder, what did the FSCA do in terms of the amendments to the FICA Act and in terms of risk evaluation? You mentioned earlier that there is a sector risk assessment that the FSCA prepared. Do you want to elaborate on what that means? What is the purpose of the sector risk assessment, and how this can possibly help the accountable institutions in the financial industry to assist them in their risk evaluation?
Yes, thanks, Michéle. Yes, we at the FSCA conducted a sector risk assessment. Now, the purpose of conducting a sector risk assessment is to understand the money laundering and terrorist financing risks in the sector that we regulate. Now, what do we do with that understanding? Obviously, one of the things that we do is we conduct supervision in terms of our understanding of the risks. In other words, a risk-based approach to supervision, which we will deal a little bit later with. But the other reason why we conducted a sector risk assessment is to understand exactly where are the risks lying in these sectors. And certainly you as an accountable institution can look at our sector risk assessment and learn from the findings of the sector risk assessment and adopt your own risk assessment that you've adopted in your business with the sector risk assessment conducted by the FSCA. Now, the sector risk assessment, you might ask, where do I find that? It is also published on our website. There's a specific tab on our website, on the FSCA website, on the AML CFT. It's an AML CFT little block. You can click on that and you will then find the sector risk assessment that has been published there. So please have a look at that, at the sector risk assessment, and please read it. It's a version, it's not the full version that we've published, but it's quite a nice, succinct, and understandable. How we conducted the sector risk assessment, we followed the methodology as prescribed by the Financial Action Task Force, and we've also looked at the sector risk assessments conducted by AUSTRAC, which is the Australian Financial Intelligence Unit, and the Financial Markets Authority of New Zealand. So in terms of the sector risk assessment, we looked at three broad criteria. We looked at threats, we looked at vulnerabilities, and we looked at consequences. And I'm going to deal with each of these elements now. So threats are those predicate offences and money laundering risks to which the financial sector may be exposed to. You might ask me, what's a predicate offence? Now, a predicate offence is something such as theft, fraud, corruption, and as a result of the threat, fraud or corruption, that money is then obtained by a criminal and then laundered. So that's what we refer to as a predicate offence. Now, how do we know what type of predicate offences has led to money laundering in the sectors that we regulate? Now, that's where we looked at suspicious transaction informations. So with other words, those are suspicious transaction reports that have been filed with the Financial Intelligence Center. But that's not all. So we also looked at money laundering, terrorist financing trends. We looked at the STR, or suspicious transaction reports, and SAR, suspicious activity reports filed with the FIC. We also looked at how many STRs, CTRs, that's your cash threshold transactions, and TPR, or terror property reports, that have been submitted to the FIC. We also looked at the type of offences that have been reported to the FIC, not only by US accountable institutions, but also by law enforcement. And then we also considered the number of licensed accountable institutions in the sectors that we regulate. Where did we obtain that information? Obviously from a suspicious transaction, cash threshold transaction, and terror property reports. That information is situated within the FIC. So there was close collaboration between us as the FSCA and the FIC on obtaining this information. We've also engaged the National Prosecuting Authority and the Asset Forfeiture Unit within the National Prosecuting Authority to understand what they are seeing from a monitoring point of view. We've also consulted the various departments within the FSCA that's dealing with these type of information. And then we've conducted research on information that can lead to the threat assessment. So what did we find? What was the results of our threat assessment? The most common reason provided by the 3 sectors that we conducted the sector risk assessment on related to suspicious or unusual transactions. So that would be the reason that accountable institutions state why they are filing the suspicious transaction. Now, you ask me, what 3 sectors am I talking about? I'm talking about the financial FSP sector, the CIS manager sector, as well as the authorized users of exchange sector. So we specifically looked at the reasons reported by these 3 categories of institutions to the FIC. Now, there's something maybe you should take note of. Please do not just say this, I report this transaction because it's unusual or suspicious. Please provide more information as to why you feel that the transaction is suspicious or unusual. What we find is that the most common issues reported in the suspicious transactions are unauthorized business, Ponzi schemes, fraud, insider trading, and tax evasion. The number of suspicious transactions and suspicious activity reports filed by the 3 sectors that I'm referring to were relatively low. It was only 0.72% and 0.41% of the total number of suspicious transactions filed by all institutions during the 2 financial years that we looked at. That's the 2016-2017 and 2017-2018 financial years. And although I'm believing there is certainly a number of underreporting going on in these 3 sectors, it is definitely an indication that there is not a lot of risk in those sectors, and because of that you will see the low number of reports. So from a threat point of view, all 3 sectors we rated as low. The second criteria that we looked at is the vulnerability criteria. Now, the vulnerability criteria refers to the characteristics of the industry that make it more attractive for money laundering or terrorist financing. The following criteria we've assessed, we've looked at clients, products and services, distribution channel, geographic location, and mitigation of money laundering terrorist financing risks. So under client type, we've looked at types of clients. That's where we looked at, for instance, are you dealing with a natural client or are you dealing with a corporate client? We've also looked at whether the client is domestically based or foreign based. We've also obtained information on PEPs. In other words, how many politically exposed persons are within these sectors. On our products and services, we looked at, for instance, is the product, can it be bought with cash? Is there room for anonymity in acquiring this product? And is there room for a cooling off period? Because we found that the cooling off period are sometimes abused by money launderers. In distribution channel, we considered factors such as non-face-to-face. With other words, if it's non-face-to-face, the risk increases. We've also looked at non-banked. Obviously, if a person is non-banked, the risk is a little bit higher because there is some due diligence that's done by banks. We've also looked at whether there is the client is onboarded through other accountable institutions. On geographic location, we've considered factors such as whether the client is domiciled in a high-risk jurisdiction, or the intermediary is domiciled in a high-risk jurisdiction. On the mitigation of money laundering terrorist financing risks, we looked at how well does the sectors comply with the requirements in the FICA Act, and that's where we considered the inspection findings from the various departments within the FSCA. We've also looked at internal audit reports on FICA Act compliance where those were available. Where did we find that information? What informed that information? And you should certainly be aware of the surveys that we conducted in 2019. That's late 2018, early 2019, where we sent all of you surveys to complete, where we tested those aspects as mentioned. We also considered the inspection results to determine the mitigation, and we looked at materiality. Now, materiality is how big is the industry? What's the assets? How many assets are in the industry? So that's the type of information that informed materiality. So what were our findings with regards to vulnerabilities in the three sectors that we looked at? From an authorized user point of view, that's an authorized user of an exchange, we rated the vulnerability as medium. The CIS manager and financial advisory and intermediaries, that's specific your category 1 FSP, we rated as low risk. And then your investment manager, your hedge fund manager, and your LISPs, we rated as medium risks. So in your investment manager space, because of the higher vulnerabilities, what are higher vulnerable or more vulnerable to money laundering or terrorist financing is first of all the client type that they're dealing with. They are dealing a lot with legal persons, trusts, non-government organizations, non-profit organizations, and PIPs. They're also dealing a lot with foreign individuals and foreign institutions. And also from a materiality point of view, because we've seen the assets under management is quite high, and therefore it just makes them more vulnerable for money laundering and terrorist financing. The third element that we looked at, the third factor that we looked at, relates to consequences. Now, consequences refer to the impact or harm that money laundering or terrorist financing may cause, and includes the effect of the underlying criminal and terrorist activity, and in this case, the financial sector supervised by the FSCA. So there are four things that we looked at: the harm or loss to the client, harm or loss to individual financial institutions, harm or loss to the financial sector, and lastly, harm or loss to the South African economy. So after considering all three factors, we did an analysis of the information. We also considered the nature, source, likelihood, and consequences of each of the specified risks. So it's very important for us to understand and getting a holistic view of the risks in the sector, considering all three factors that we've looked at. And then we've allocated an average rating to each factor. So from a sector risk assessment, we've rated the authorized users then as medium risk, CIS managers and your financial advisory and intermediaries, that's more your category 1 guys, as low risk, and then investment managers, hedge fund managers, and LISPs as medium risk. All right, so that is on the sector risk assessment point of view. So, Michéle, since you're dealing with supervision, how is the sector risk assessment influencing your supervision, and what's the difference between a risk-based approach to customer due diligence and a risk-based approach to supervision?
Well, Charl, at the back of what you've just explained about the sector risk assessment, and you also mentioned that while the FSCA issued surveys as an initiative or a component of gathering information from the industry itself that informed the results of the sector risk assessment amongst other sources of information. I think in explaining the concept of the risk-based approach to supervision that the Financial Sector Conduct Authority applies, we have to be cognizant of the fact, first of all, that this applies from the date of market entry throughout the life cycle of an accountable institution. And any risk rating that's possibly attached to an accountable institution is subject to adjustment, either in terms of a higher or a lower risk, due to the behavior of the accountable institution, as well as the information that we as a supervisory body obtain during that life cycle of the accountable institution. So we risk rate accountable institutions based on the inherent risks that we've identified and elaborated on in another presentation that is available for accountable institutions using this platform. And those inherent risks really relate to the characteristics of an accountable institution, the nature, size, and complexity of and the structure of your business, right down to the nature of the customers, the geographic location, the distribution channels, as well as adverse information that extends to sub-items such as previous convictions or sanctions that could impact our view of the risk that should be allocated to an accountable institution, as well as other information that we obtain during licensing or supervisory or enforcement activities that relates to complaints, tip-offs, irregularity reports, and the like. Certainly, during the performance of our supervisory activities, be it desk-based supervision or inspections, we also gain additional information that tells us more about the accountable institutions whose level of compliance with the FICA Act we are responsible for monitoring. So we conduct on-site inspections, and we also issue statutory returns such as a compliance report that is being revamped and reviewed, as well as a directive to provide information. So clearly, in terms of the volume of accountable institutions that are being supervised for MLTF compliance by the Financial Sector Conduct Authority, we are mindful of volume, but even more importantly, to apply our resources appropriately to the risk that is presented in terms of some accountable institutions being a higher perceived risk and some a lower perceived risk. And we will definitely allocate our resources and our energy to focus on creating awareness and conducting supervisory activities where the risk is the highest. And I would like to highlight one of the activities, and that being the inspections and our new approach to inspections.
Yes, talking about the new approach, because I'm certain the accountable institutions out there are asking the question, you know, I'm drafting my risk-based or risk management and compliance program. How are you going to expect it? Because certainly, you know, there's some subjectivity involved there as well. Can you maybe explain your new approach?
Definitely, Charl. So our new approach is really three-pronged. So in the past, I think the accountable institutions in the industry will agree our approach was much more compliance-driven, and to use ugly terminology, tick box compliance. And we had to make a mind shift as inspectors, as we expect the industry to make a mind shift, moving from a rules-based to a risk-based approach. And that applies to how we supervise and we conduct inspections. So I mentioned we use a three-pronged approach. So the first would be, yes, we need to be satisfied that an accountable institution, in fact, documented and developed the necessary policies and processes, such as the risk management and compliance program, so that it can consult that document in terms of how it should conduct customer due diligence, evaluate its risks, report the necessary reportable transactions or activities to the FIC even. But that deals with technical compliance. It's the document where it is evident and the accountable institution can provide proof that it has taken into consideration the regulatory requirements, particularly in terms of Section 20A to 21H and Section 42 of the Financial Intelligence Center Act. So as we mentioned, in that risk management and compliance program, it's also important to make sure that that document shows which risks we in fact identified as accountable institutions. So once we do an inspection, we will look at the documentation, in particular your risk management and compliance program, compare that to the regulatory requirements, and you will recall you earlier talked about the fact that some rules still do apply to a limited extent. But that also then, in terms of the risk-based approach, how that aligns to the nature of a particular accountable institution's business. Once we are comfortable that the policies and procedures are in place and it actually matches the profile of the business of the accountable institution, we do a soundness test. So that is typically where we engage the accountable institution, particular senior management, to see and assess really whether the accountable institution in fact understand their risk. Can you explain your inherent risks and your controls in the money laundering and terror financing environment to the supervisory body, to the inspector sitting across from you? And does it make sense if you would have to take that same explanation provided by the accountable institution together with the documented policies and procedures, if one had to apply that as an independent third party, would that make a difference? Which brings us to the last and one of the most important items that we focus on during inspections, and that is effectiveness. So there's really not much value in having a very good and comprehensive risk management and compliance program and ancillary policies and processes to mitigate MLTF risk, or even being able to articulate your understanding well if those policies and procedures are not implemented, and that implementation does not in fact make sure or evidence that the technical compliance translates into effectively mitigating and combating money laundering and terror financing risk in your particular accountable institution. So we do that by sampling client files, bank statements, and the like to verify whether the implementation took place and does take place on a daily basis in the operations of the accountable institution, and whether that in fact makes a difference. Does it make the situation better? Are the risks in fact mitigated? I hope that explains the risk-based approach applied by the Financial Sector Conduct Authority in the money laundering and terror financing environment. I hope you enjoyed this presentation, and we hope to present many more items to give you guidance and perhaps answer your questions that you have in the back of your head, especially in an environment where face-to-face engagement is problematic due to the pandemic. I thank Charl, and I trust you have a good day.